Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming out of a weekend. It's a Monday morning, start of a new week. We are coming to you live, as always, from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleague Sonia and Nigel. Guys, hi, good morning.
Hi, good morning. Good morning. The weekend went by pretty fast. I mean, it was like I was sitting with you guys on Editors Roundtable, 1 hour ago.
And you told us that you don't want to see us, right? So we kind of stayed away.
You made yourselves invisible over the weekend. But how was the weekend, guys?
A great weekend. I mean, I had a good time, spent a lot of time with my family. And
Arsenal's had a big win as well.
Arsenal had a big win last night. It was a hard-fought win. You know, the scoreline at the end of it was 2-0. But it was a hard-fought win. And good to see Arsenal still with a chance, putting the pressure
closer
on
to
Man
the
City.
title, right? Closer to the title.
But guys, we have a full 5-day week.
Which one is not used to, but I think we'll have to, right?
Yeah.
I mean, there's no option.
But I think the Bulls are going to like that because there is a little bit of ammunition to take the markets ahead, right?
It looks like it. And like Arsenal, will the markets have a hard-fought victory? I think that's the point to see. You know, the point is that it's almost like 1 week, 2 weeks, the market does well. Then there is a bit of a pause. I mean, the last week was that pause with the Friday correction that we saw. Will this week be the week where the market maybe is able to sort of put on some wings? Now, the reason I'm saying that is because Friday, suddenly things turned. And the reason they turned is because you had global equities which rebounded in a very spectacular fashion. So you got the NASDAQ, you got the S&P, you got the Dow, the Russell 2000, the troubled regional banks, all of them flew. The changes are up on your screen. And this is quite something, isn't it? Now, the reason is very simple. The reason is data was strong. Just last week, we had, of course, the Fed decision. There was a hike. And many were saying, well, you know, they're going to be on a pause, extended pause, etc. What do we get on Friday? We got a super strong, unquestionably strong U.S. jobs data, jobs report, right? The labor market, which is the number one priority, which the Fed wants to cool down, came in. And this was the strongest April in some time. And the market responded the way they did. So in a way, what the reaction on Friday from the market tells you is that the market has kind of moved on from, trying to price in what higher rates will do, but they are looking at the damage to the economy. And as long as the economy seems to be in decent shape, the markets are in decent shape as well. Now, U.S. yields were higher, not by much. I mean, the 10-year was up for about 5 basis points. Market pricing of Fed rate cuts pulled back. So before the jobs data, the market was pricing rate cuts of 100 basis points through 2023. After the data, that pricing came down to 75 basis points. Oil prices also rebounded. They've been sinking. They're up about 4% on Friday. Now, this is, of course, the global setup, and this kind of is an improvement after a lot of pessimism around growth, recession, etc., etc. The U.S. economy, according to this data point, is still in a pretty fine fettle, pretty fine form. Where does that leave us here in India? The Nifty on Friday cracked. I mean, it fell about 1%. The Bank Nifty fell even more, 2.25% or so. Supports, I want to start with supports once again. The SX is indicating a slightly higher start. We'll come to that in just a bit. Supports for the Nifty come in at 18,042 and 18,000. These are the two supports that you need to kind of keep in mind as you go into today's session. The resistance for the market comes in at 18,267. These are very near-term levels, 18,267, 18,300. Those are pockets into which the market will find resistance. It'll have to fight through these levels to kind of eye the new highs, etc. So this is the setup on the Nifty. The Bank Nifty has supports at the 20-day moving average, which comes in at 42,320. And then the resistance for the Bank Nifty comes in at 43,740 as well. So for the Nifty and the Bank Nifty, if you do get a bit of a sort of up and up move, there are resistance pockets which the market, both the indices, will run into. But the thing is, after Friday's almost a waterfall kind of a decline that we saw, you have a bit of data out of the US, you have a bit of global price action which perhaps stems that fall a little bit and provides hope that maybe, just maybe, over the next week, 2 weeks or so, the market at least sort of, runs up a little bit, touches that all-time high. It's closer for the Bank Nifty as compared to the Nifty, and then we'll see where the market wants to go from there. Sonia.
Absolutely. I think things are stacked in favor of the bulls, right, this week. At least that seems to be the moot point. So can the bulls make a comeback? There's definitely a lot of ammunition. The Nifty, remember, is facing a bit of resistance at that 18,200 mark. So the important question is whether there is enough in the cues to take the Nifty above that level. There are strong global cues. FIs have made a big comeback, 7 straight days of buying from FIs. In fact, FIs bought about 770 crores on Friday. There's large selling from DIs, so let's not forget that. But put together in May so far, in the first week, there's over 5,500 crores of buying from FIs. So definitely there is, ammunition over there. Strong global markets, as we've been telling you. The SGX Nifty is also indicating a 30-point bump up. The Asian markets are looking pretty good. Very good, US jobs data. And not just that, the unemployment level in the US has dropped quite a bit. This is the lowest unemployment that the US has seen since way back in 1969, coming in at just about 3.4%. So that's something that the street is going to take with both hands. But back home, a couple of cues that I'm tracking, mixed, result reactions today. You've had good numbers from Paytm. So that's one of these platform companies that would be in the news today. Good revenue growth. The EBITDA before the ESOP cost has been solid as well. And for the full year, the contribution profit that we track closely, that has improved about 50%. So that's something to watch out for. On Coal India, it was a weak operational performance. There were higher wage provisions. So that's something that the street may not like. But there are a lot of results to watch out for this week, largely from the pharmaceutical as well as the auto space. So we begin with Lupin, Lupin, Dr. Reddy's through the course of the next couple of days. There's Cipla at the end of the week. In the auto space, there's Apollo Tyres, Bosch, Escorts, Eicher Motor. So it's an action-packed week in terms of earnings as well. But that's the big question, right? I mean, the SGX Nifty today is indicating the start will be in the green, but that 18,200 mark has been a bit of a congestion zone for the market. Important to see if that gets taken out.
Well, that's right. It was a weak close actually on Friday, both for the Nifty as well as the Nifty Bank. So we start off in the green, but that congestion zone, 18,250, 18,300, as we've seen last week, that continues to hold out. The Nifty Bank, that's going to be the swing factor. Remember, it had a very weak close. Yes, HDFC Bank was tracking in Friday's trading session. The problem was suddenly Federal Bank came out with a set of numbers, didn't look too good. And that's why you had the Nifty Bank that ended virtually at the low point of the day. Now, holding on to this 42,500, 42,600, that's a very, very important range. Because on the way up, that was a bit of a resistance. If that level can be held out, well, the bulls will feel they're still in with a chance. The institutional flows, that needs to be tracked very, very importantly. And I say that because the net institutional numbers, they were positive. That's putting the FI and the DI numbers together. But in Friday's trading session, well, it was a negative 1,400 crores odd because of the DI selling that was reported. Now, that's important because the FIs, yes, they continue to buy. But the buy number, net buy number was down to close to around $100 million odd. We were getting used to that $350 million odd. So the FI buying slowed down a little bit and the DI selling picked up. So we'll keep an eye out on the institutional numbers. The FIs, what do they do in the FNO market? Well, they added close to around 10,000 short contracts and now they're back to being short on the index. So close to around 55% of their positioning is on the short side. Not a bad thing. In fact, I would like this number to go up a little bit because in case the flows don't support, then these shorts in the system will support the bulls. On the option side, they bought more calls than puts. But the important point to note is the way they're writing calls as well. Close to around 3.5 calls were written for every one put. So at higher levels, you're likely to see a firm resistance out there. And that's the way the PCR as well. And the PCR went dancing away to around 1.35, which is the upper end of the range. Now that's cooled down to around 0.85. No, it can go lower. Yes, it can go to around 0.65, 0.7 odd, where we normally see it pace out. So just keep an eye out on that mark. But what were they writing on the call side? 18,200 call, 18,100 call. And, just plugging in those numbers, you're getting the resistance zone. Because the 18,100 call, the premium was around 150 rupees, 140 rupees. So, that's giving you the resistance zone on the upside. But risk reward could favor. If you want to buy, you should be looking to buy closer to around that 18,020, 18,050. That's what the options data suggests, and that's what's been profitable as well. On the Nifty Bank, very, very important that it holds on to those lows that I just mentioned, or that support zone. While on the upside, last week's high, well, that'll be a bit of a resistance zone. My take is today is that don't rush into buy at the start because we're going to get 30, 40 point higher. Maybe if you want to get in closer to around the support zone. That's 18,020, 18,050. Otherwise, we're back to that range. So let's see how this one goes.
All right, Nigel, thanks for that. Well, before we go any further, let's quickly tell you what's lined up here in the first 30 minutes of trade today. We get you updates from markets across the globe. Ed Yardini of Yardini Research will join in to discuss the global trade setup. Our research team brings you CNBC-TV18's list of top 10 stocks of the day. At 8:30, we have our market expert Prakash Devan joining in with a take on stocks he likes and results he likes and dislikes.
All right, let's kickstart the show. On the equities front, we have two views coming in this morning, so let's get both of them out. Lawrence Belanco of CLSA says the Nifty continues to work its way higher following the breakout from the short-term downtrend. He says the next event is a test of a major overhead resistance at 18,363 area. He adds, looking at the MSCI India Dollar ETF, we have a short-term base in place with the recent break above $40.3. He says the Nifty Bank Index has been a key driver for the Nifty's recovery rally of March lows and flags that State Bank of India is a good buy candidate.
Okay, Gautam Dugar of Motilal Oswal says that fourth quarter FY23 corporate earnings so far have been in line but lopsided with performance of heavyweights such as Reliance, Axis Bank, ICICI Bank, HDFC Bank and TCS driving the aggregate. He says spread of earnings has been decent with 77% of their coverage universe either meeting or exceeding profit expectations. However, he adds growth has been led only by BFSI, auto and tech. A bit of a repeat of the third quarter. He says after a flat F523, Nifty now trades near 18 times 1 year forward PE, which is a decent drop from the level of 21 times seen at the beginning of F523. He maintains their overweight stance on financials, capex, autos and consumption. Goes on to say they're neutral on IT, healthcare, while they have an underweight stance on metals, energy and utilities in their model portfolio.
Okay, let's also get you some views on how the money markets could shape up today. B. Prasanna of ICICI Bank says the end of the rate hiking cycle indicated by a dovish Fed hike and regional banks crisis kept the dollar under pressure. He says the dollar traded near a yearly low but found some support by stronger than expected jobs data at the end of the week. He says the rupee traded in a narrow range with an appreciation bias, with the RBI recouping dollars against inflows. He says FPI inflows and a weak dollar are helping domestic currency in the near term, and he expects the rupee to trade in a range of 81.40 to 82.10 this week.
On the bonds, B. Prasanna says global yields soften as FOMC shifted to a data-dependent approach. He adds, though economic trends remain robust, risk of contagion from banking crisis and an eventual sharp economic slowdown kept expectations for faster rate cuts alive. He says local yields drifted lower as well on the back of strong investor demand and expectations of peaking out of the global rate hike cycle. He expects markets to consolidate at current levels with a 10-year benchmark range bound between 6.9 to 7.1%.
All right, we have plenty of news flow that came in on the weekend, and we'll get to all that stock-specific action in just a bit in our special Top 10 segment. We're looking at Britannia, Marico, Paytm, IndusInd Bank, their stocks on the back of positive news flow. While on the flip side, you have Coal India, Aditya Birla Fashion, TCNS, Sun Pharma, Adani Gas, as well as Adani Transmission, their stocks that could be reacting to negative news flow.
Okay, well, Ed Yardini is with us. He's president at Yardini Research. Ed, good to have you with us here. Thank you very much for your time. I mean, what do you make of the April jobs report number out of the U.S.? This is, are you surprised? Does it change things? We get the core CPI number later this week out of the U.S. And of course, it's interesting to see the market reaction, right? Markets clearly worried about a big slowdown rather than maybe rates going up a little bit more or staying here.
Well, I think the numbers definitely confirm that the economy is still growing. It's not in a recession. There have been some of the bears saying that we're going to have an imminent recession. But, the employment data is one of the four components of the index of coincident economic indicators. And it's probably the most important because it tends to influence the other ones. And the index of coincident economic indicators in April is likely to be at an all-time record high. So how can we really talk about an imminent recession when the economy is doing so well? I'm really not that surprised by the strength of the labor market. I've come around to think that demographics is having a very powerful impact on our demand for labor. A lot of baby boomers are retiring, and they're pretty well off. And what they do is they go out to restaurants, they go traveling, they go to health services, and that's where we need all the jobs. So notwithstanding the fact that we've seen a 500 basis point increase in the federal funds rate, the demand for labor remains very strong. And part of it may not be interest rate sensitive at all.
So the recession fears in the US are now beginning to fade, not just with the stronger jobs data, but also with the way crude is shaping up, right? There's been a recovery there. Are you getting a sense that there may not be a full-blown recession at all in the US? And if that's the case, how do equity investors across the globe approach this?
Well, I think that a lot of issues have kind of come together very quickly here. I think the reason the market did so well on Friday was because, as you said, the economy still shows no signs of falling into recession, or no serious signs. Clearly, some sections of the economy have been in a recession, and yet their employment is at an all-time record high. Look at construction. Construction and employment's all-time record high. Look at truckers. Truck drivers are all-time record high. So I think that's helped the market. The concerns about the market has been that it's fairly narrow. It's been kind of the mega cap 8, the biggest technology names. And actually, it's been the mega cap 2. Microsoft and Apple now account for 14% of the market. I think on a global basis, the U.S. is looking like its economy is doing pretty well. And that should actually be a positive for the dollar. And it may be a bit of a hurdle for markets overseas.
Hi, good morning, Mr. Yardney. We here in India, we wake up to news that one regional bank or the other has more 40% or 50% higher or 40, 50% lower. Do you think that this banking crisis could actually come to derail everything? Or do you think it's pretty much being taken care of? And also in that sort of a backdrop, going by all that you said, I think in the last time we chatted, you briefly hinted that maybe the S&P 500 starts trending towards that 4,600 odd mark. Is that still on the cards?
That's still my target. I still think we'll be at 4,600 by the end of the year. I think in the short term, the market may continue to rise here maybe by another 2%, but I don't think we're out of the trading range just yet. We've been actually moving sideways with a lot of volatility around 4,000 since last summer. And so I do think that it's going to probably be later this summer, early fall, where the market starts to move towards 4,600.
Where does it leave emerging markets? I mean, do you expect the dollar to strengthen a little bit? Because, I mean, again, there have been calls for imminent demise of the dollar as well, which perhaps may not pan out if the U.S. is still okay.
Right. Well, one thing I didn't mention that I was just asked about was the banking crisis. And I think the banking crisis is going to limit the Fed's ability to raise interest rates. The Fed doesn't have to do another 100 basis points if the banking crisis basically amounts to a 100 basis point increase in the Fed funds rate. So I think that's something important to consider. On the other hand, the strong economy may very well continue to cause inflation to persist a while longer. And so the Fed, I think, is sort of where it wanted to be. It wanted to be restrictive. It's there. And I think it's restrictive enough to keep the dollar relatively firm. Emerging markets, I think it's, I don't think we can generalize. India's done quite well over the past couple of years. There's a lot of geopolitical issues now where investors that used to go to China are starting to have second thoughts about that. And of course, we're seeing companies looking to move their supply chains to places like India. And so I think some emerging markets are going to benefit from the increasing geopolitical tensions.
So since we're talking about India, right, there are two things that's working in India's favor. One, of course, is that earnings have picked up, especially in large pockets like banking, auto, technology even. And the other thing is that valuations are now looking better than they were at the start of FY23. I mean, we were trading around 23 times forward, and now India is at about 18 times. Do you think these two reasons are reason enough for the bulls to sort of come back, for the uptrend to resume in the Indian markets?
Well, I think the factors you're mentioning, earnings and valuation, are always the key drivers of the markets. But I think we also have to factor in, as I mentioned before, the geopolitical developments. The world is changing, and it seems to be splitting into two spheres of influence, China's sphere of influence and America's sphere of influence. India sort of falls kind of in the middle. It is sort of in that sweet spot where it will continue to benefit from the growth in Asia generally and China in particular, but I think it also will benefit in being considered to be a world-class democracy along with others that, and therefore a member of both spheres of influence.
All right, Ms. Yardney, always good hearing your thoughts. Thanks so much for stopping by and filling
you.
us in with your inputs. And let's hope by the end of this year, the mother market, that's the US market, S&P 500, could head to around 4,600 odd. Well, time to slip into a short break. When you come back, as promised, we'll get straight to the top stocks that you need to track. Don't go anywhere.
All right, welcome back. We are beginning the day with positive cues. The global cues were solid. FIs have been buying for 7 straight days, and the SGX Nifty is also indicating that we're headed for a positive start. But let's talk about a lot of things in the market and some stocks to look at as well. Britannia is the first stock on our radar. Very good performance coming through. So definitely you're not going to say 50-50 for this one, Mangalam?
I would say more of a Jim Jam for Britannia this time around because the tastiest part is in the center. If you just take a look at their EBITDA, 800 crores versus street expectations of 705 crores. So they more than made up for a mild miss that we saw in their revenues. The revenues of the company posted was 4,023 crores versus expectations of 4,050 crores. As a result of which, the net profit also 557 crores. Most on the street were working with a number sub 500 odd crores. What led to this deliciousness in the middle? It was the gross margins that expanded 700 basis points year on year, 120 basis points quarter on quarter, and they are at an all-time high. The company says that this is the band that they will be working with in FY24 itself. The domestic volume growth just came in at 1%, so that's one fact which was below street expectations. But the company is clarified on that. That's because the biscuits became smaller as compared to last year, and at the same time, the pack size grew by about 12%. So the number of packs that sold were 12% higher. The other good factor was that the non-biscuit portfolio of the company grew by about 1.5 times. And Varun Berry has been reappointed for the next 5 years. So that indicates some stability at the top too.
Okay, all right. Mangalam, thanks a lot for that. Well, I'm focusing on Coal India. The numbers came in on a Sunday afternoon, and the numbers were mixed, actually. On the top line, it was a beat, so there were a few positives out there as well. Top line beat because the other operating income was up by close to around 9% on a sequential basis as well as year-on-year basis. And realizations were actually better than what the street was working with. It came in closer to around 1,880 rupees. That's around 50 rupees higher than what Nuvoma, for example, was estimating. And the FSA price hikes haven't come about. But yes, FSA prices have moved up. Realizations have moved up by 5% on a year-on-year basis because the focus is on mix. And they could be selling more amount to the non-par segment, which helps them on the realizations front. Now, that's a positive read-through. E-auction prices on expected lines is higher, but sustainability is going to be questioned. The reason for the margin as well as absolute EBITDA miss is because employee costs spiked up to around 17,000 crores. That included provisions for wages of around 5,900 crores odd. Miss on operating profit led to a miss on the profitability front as well. They've declared a dividend of around 4 rupees. So for the year, it's nearly around 24 rupees 50 paise odd. The key trigger, though, for the stock from here on is the FSA price hikes because e-auction prices will dip from here. So we need to wait by for that. That didn't come about. So expect the stock to open up flattish with a mild negative tick. And then maybe we see a bit of a recovery. But Mangalam, coming back to you, what about Marico? How were those numbers?
Well, Marico reported numbers were largely in line with street expectations, and there was never any concern about that anyway because the street was prepared by the company's fourth quarter update. Revenue coming in at 2,240 crores, street working with a number of 2,275 odd crores, EBITDA as well around 400 crores, so largely in line. The net profit was a mild beat, but that was led by higher other income at 68 crores versus 24 crores, so that was explained as well. What was a big positive was the management commentary, where they said that going forward, they expect domestic volume and revenue trajectory to improve. At the same time, gross margins are expected to improve by 200 to 250 basis points. They'll use some of that in increasing ad spends, but EBITDA margins actually going forward should improve by at least 100 basis points. And the other growth drivers of the company, which is foods, premium personal care and digital brands, they expect growth of nearly 33-34% in FY24. That would mean that it is 20% of their overall business as against 15% in FY23.
All right, Mangalam, thanks very much for that. Now let's shift focus to Paytm. There is news flow there, and IndusInd Bank as well. Abhishek has got both those in sight. Abhishek, morning.
Morning, Prashant. So to begin with the April business update that Paytm is given, it looks like a soft month for them on a month-on-month basis. So number of loan disbursed is down about 2.5% month-on-month. Value of loan disbursed has actually declined 8% month-on-month and is at 3-month low of 4,115 crores. Gross merchandise value, that's up 33.7% YOY, but a decline of about 0.8% month-on-month. Calculation shows that the average gross merchandise value per MTU is down about 2.94% month-on-month and is lower than that of what you saw in December 2022. So disbursements ticket size is the lowest in the last 4 months, coming in at 10,037 per average disbursements, which is down about 10.15% month-on-month. Q4 performance remains strong. Total income is up 49.5% YOY and about 15% sequentially. The contribution profit margin has expanded to 55%, which continues to help in EBITDA being positive as well. So the net loss has declined to about 167.5 crore when compared to 392 crore in the previous quarter and about 762 crores in the same quarter last year. IndusInd Bank, there is a change in the top management. The key chief risk officer has actually resigned, so he'll be moving on to lead risk function at another MNC bank. Mr. Mullidhar Lakara, who has been assigned the new role of head of newly formed assurance functioning, which is reporting to the MD and CEO. He was earlier the chief compliance officer, so over there they will be replacing him with Sachin Patange. Back to you.
All right, Abhishek, thanks a lot for that. And you were on top of that one as well. Thanks so much for joining and giving us your inputs on a couple of those stocks. But Mangalam, the long-awaited deal was finally announced. That too almost midnight on Friday. ABFRL as well as TCNS. How do you read that?
It was so long awaited that, when it was finally announced, it seemed like a bit of a footnote, Nigel. But it is definitely an announcement that has been made. If you just take a look at the swap ratio, however, it seems like ABFRL got the better end of the stick because the shareholders of TCNS will receive 11 shares of ABFRL for every 6 shares that they hold in TCNS. If you just take a look at the stock prices on Friday, 11 shares of ABFRL would give you about 2,356 odd rupees, whereas 6 shares of TCNS is worth 3,125 rupees. So basically, it values TCNS at around 393 rupees per share, which is lower than even its 52-week low on the stock. And the stock, of course, has seen a 45% correction from the top. So expect TCNS to open sharply in the red today. ABFRL has also gone ahead and announced an open offer for 20% equity at 503 rupees per share, but brokerages are more concerned about their capital allocation policy. So a long tail of acquisitions that ABFRL has done, Motilal Oswal says that are presently loss-making or yet to stabilize. So this prolonged phase of investments for them could actually impact their earnings. This acquisition itself, as per MOSL, could have an 18% impact on their EPS. So they've downgraded the stock with to a neutral rating with a target price of 245 as well. So see a red on both these counters today.
All right, Mangalam, thanks very much for that. Sun Pharma has got news flow as well with their Mohali plant in focus. Ekta has got more details. Ekta, hi.
Thanks for that. Well, yes, I expect Sun Pharma to be in the red because we have managed to access the non-compliance letter which was issued to Sun Pharma's Mohali facility. Now, remember that the news came out some time ago, but we didn't know the details of the non-compliance letter. So they have indicated that, it was this was a part of the consent decree which Mohali was a part of in Jan of 2012. And they have indicated that, there are some concerns with regards to API contamination, etc., which have been brought up in the non-compliance letter. Now, Nomura has written on it. They say that the key concerns seem to be around data handling, data integrity, process control out of specification. Mohali's US sales are estimated to be $100 to $150 million. So they may face disruptions in the near term. There could be a permanent loss of market share while they undertake this remediation because they have to get an expert on board. There will be batch-to-batch certification. So all of this is going to be pushed out for a couple of months. And according to Nomura, the stoppage of supplies of one of their key drugs, which is a colon drug, Pentasa generic, which is expected to be manufactured from this unit, could adversely impact their profit margins in the near term. And that's the reason why you could probably see the stock in the red. That, along with the fact that data integrity concerns have probably been brought up in this particular unit.
Okay, thanks a lot for that. So Sun Pharma could be in the red, non-compliance letter issued to its Mohali plant. I'm sure the street is not going to like that. In any case, in the last 1.5 months, the stock has lost a bit of value, about 5 to 10%. So maybe more downside in store. But the other group of stocks that I'm watching is the Adani stocks. So there will be two stocks in focus this morning, Adani Total Gas and Adani Transmission, and I'm going with red over there. The MSCI has updated on the treatment of Adani Group stocks in the May review. They will be reducing a free float in the Adani Transmission and Adani Total Gas stocks. Now, the float reduction, remember, was postponed from the February review to the May review. And as we had told you earlier, there is an estimate from analysts that Adani Total Gas could see an outflow of $90 million, while Adani Transmission could see an outflow of $132 million. So I'm going with red on these two stocks. But here's a quick recap of our top stocks, stocks with positive news flow. There's Britannia, Marico, Paytm and IndusInd Bank, while stocks with negative news flow this morning, Coal India, Aditya Birla Fashion, TCNS Clothing, Sun Pharma, Adani Gas and Adani Transmission. But let's also get a bit of a handle on what's happening in the world of crude. Crude has made a tad bit of a comeback, after the strong jobs report that we got in the US. Manisha Gupta is joining in for a roundup of all the action there. Hi, Manisha. Good morning.
Morning, Sonia. Thank you for that. Well, yes, we did see crude oil prices gain up by 4% on Friday. But on the week, we were still 7% on the weaker side, and this was a third straight week when the crude oil prices has posted losses. The strong U.S. non-farm payroll data clearly has been supportive, but the new week, brings in many more data points to watch out for. You have the China trade data that's coming in on Tuesday, and then Wednesday is data-heavy day. You have Chinese inflation and the U.S. Consumer Price Index, both of these numbers coming in. So ahead of that, you are witnessing some choppiness. So even as the crude oil prices have come back above $70 a barrel, for both the varieties, it is the metal sector which continues to lag. Copper prices are trading at a 4-month lows right now, and the China's premium has now declined because of enough physical availability and lower demand there. Even the iron ore prices have continued to fall, so we're looking at a 5-month lows here, below demand from China's steel makers, and contraction in the manufacturing sector in China and US seems to be weighing onto this price as well.
All right, Manisha, thanks very much for that. So that's crude oil in focus. It's reacting to what's happening to the underlying perception of what's happening to the underlying economy and the jobs number turning things around a little bit. We'll take a quick break here. Prakash Diwan will join in for a chat on the top stocks you need to know and watch out for as we start another day of trade. Later, we'll also have the management of Aether Industries to talk about their fourth quarter and FY23 earnings. Stay tuned. Those conversations are coming up.
Welcome back. Hope you're having a good morning. The S-Shakes, if we're suggesting, we're likely to open up in the green, but there are plenty of stocks that we need to focus on and discuss. We have Prakash Diwan, who joins us to help us out with just that. Hi, Prakash. Good morning. There were a couple of results that did come in, but I think the big, long-awaited deal between TCNS as well as ABFRL, well, that's got announced. Now, on the margin, it appears that this will be dilutive on the margin front. And I was looking at a Motilal Oswal note. They have pulled back the EPS estimates by around 18%. How do you view both these two stocks, particularly ABFRL? That stock could be under some pressure today.
Good morning, Nigel. So I do agree. It's a deal where probably ABFRL has chosen to pay for a expansion, with quick expansion, not just earnings. So very clearly, I think the kind of brand portfolio that they end up acquiring, and given their distribution, superior distribution strength, they'll probably be able to sweat it out much more. So you have a new segment that you add altogether, and you have a line that's probably well established. So you really don't have to invest into building the brand, but rather making it reach the people in a far more superior way, which they could do. And that means that it'll be probably back-ended. Once all of that happens is when the margins will start probably coming positively. But at this point, I think it's a very clear, conscious decision to utilize cash to expand quickly rather than organically. So I don't know whether it's 18% or whether it's 10-12% in that dilutive sense, but it could be dilutive. But for people who believe in this story now, after it's kind of broken through from a lot of the other hurdles that it faced in lack of scale, I think there will be takers for it at some point in time soon, but not maybe today itself.
Okay. The stock of the day, one of the stocks of the day, Prakash, good morning, could be Britannia, right? Rock solid numbers, margins at
Yes.
all-time highs. And the best part is Varun Berry is back for another 5 years as MD of the company. At this price, 4,600, is the risk reward still favorable? Because it's had a pretty strong run in the last many months.
Good morning, Sonia. So, you're absolutely right. What the company's done is it's set a path for growth for the next 4-5 years very clearly. And look at some of the newer segments that have reached the 100 crore club, I mean, you never thought that some of these sub-segments, these niche segments could kind of grow into, that 100 crore mark. Now, when that happens, and, thanks to all of that the margins are so significantly richer, the company also creates a moat for itself, as compared to a Vectors or as compared to some of the unlisted names which are competing or gnawing at on its toes. Britannia is going to march ahead with a very strong moat given their utilization of the right price points and the right grammage. There has been some changes in the grammage across the industry, but Britannia has been most favorable in that sense where it's not kind of diluted their volume growth. So I think all in all, if you keep analyzing these metrics, and we've spoken about Britannia, even when it used to be about sub 4,000, saying this is significantly, offering value. I feel it might not be as favorable as what it was about 6-12 months back, but it will continue to give you a very significant growth path. So don't stay away from it. At some point, you will have to have it in your portfolio as compared to, let's say, a slow-moving, FMCG play like an HUL or, even Nestle, which is kind of getting to be too big and slow. So, I think Britannia is agile. Britannia's got that momentum. Those tailwinds are definitely working. And that's something which will probably last for much longer than just a couple of years.
Prakash, Federal Bank, good morning. What do you do with that one? It sold off 8% on Friday. Main problem was margins, which were under pressure. Although the management at the end of the third quarter had said that margins will be a little lower in Q4 as compared to Q3. And this is largely a function of deposits repricing. Your view on the stock and whether there are any broader implications, because deposit repricing is something which will play out. It's slower than repricing on the advances side, but it will catch up for most banks. Your thoughts?
Good morning, Rishan. Absolutely. So, Federal Bank margins coming under pressure because cost of funds going up. I mean, there's absolutely nothing surprising here. I mean, it's just a question of which quarter that digestion happens to the business. I mean, you saw DCB. DCB probably seems to be doing things with a lag, and that's where you have an multi-quarter high in terms of NIMs. But at some point in time, that will also kind of start rationalizing. So my sense is Federal Bank has all the building blocks to achieve that kind of a growth that they set out for themselves. And to be honest, there is no other bank in that size which is so competitively placed or strongly placed. So I've always liked the bank. I've liked the way the management thinks, the way the expansion on the MSME has been so successful for them without compromising on any kind of quality of the books. So this is a matter of time. When you're not at the beginning of the interest rate hike cycle, Prashant, fortunately, you are probably staring at the fag end of the interest rate hike cycle, and which means that the cost of funds will only kind of start getting benign. So when that happens, you'll probably see margins come back. Growth is already in place. The expansion is in place. So the dip that you saw was probably because of the high expectations from banks, and Federal being one of the good ones, probably disappointed. So buy on dips is definitely something which is going to work for you.
Okay, the two other stocks I want to discuss with you, and I'll give you some time to ponder over it. One is Paytm, which has very good set of numbers, and the other one is Bharat Forge. There are some upgrades that have come in on the stock post the earnings. Nomura has upgraded it, but I'll give you some time because we have the management of Ather Industries joining us now. So Prakash, I urge you to listen into that as well. It was a good set of numbers that Ather Industries reported, boosted by commercialization of the Site 3 from Q4 and some long-term agreements as well. The company saw a healthy growth across parameters with CRAMS and the contract business continuing to grow. Aman Desai, who's the founder and director at Ather Industries, joins us now to talk about that. Aman, very healthy growth of 25% is what you saw in the top line. But you also spoke about the pharma segment being subdued in the first half of FY23, and that's something that other, specialty chemical companies spoke about as well. Can you tell us, is there any improvement that you're expecting in FY24 in the pharma space, and what is the demand on ground currently?
Yeah, good morning, Sonia. Pleasure to be here again. Yes, good set of numbers we have posted in the last quarter, which shows a healthy return and healthy growth quarter on quarter, year on year. And so we are happy with that. Very positive and very upbeat on the future outlook. In terms of your specific question on the pharma, yes, the first couple of quarters in the last fiscal year were soft from the pharma sector, but already in the last quarter and the quarter before that, but more prominently in the last quarter, we have seen the demand and the requests from pharma start rolling in and going back towards normal. And so certainly in fiscal 24, we expect to see pharma back into where it used to be last year or a couple of years ago, and post good growth on the pharma sector as well.
Right.
So could you just corroborate that with some numbers? If the pharma segment is going to return back to, growth on a consolidated basis in the sense of margins, I mean, you've seen your margin expand to about 30% in Q4. Is this a sustainable number? Could you build on to that as well?
Yes, certainly. So we have always speculated. We've always mentioned that our margins and our profits will be around where they are today, which is 30% EBITDA and 20% profits, and so we expect that to remain. And in terms of the margins being affected by the pharmaceutical getting back up to track, yes, there will be some impact, but not much. But we expect to be posting healthy margins and healthy profits in the quarters to come.
All right, Aman. I recall last month when we spoke, you said, Nigel, you have to wait a little bit longer for the revenue growth guidance. So now you've given us your numbers. What's the outlook like for FY24? Margins, you had mentioned 29-30% is what you want to sustain. So on the margins front, I just want to ask you, R&D as a percentage of sales, that's moved up. And you've been mentioning that that's one of your strengths of the company because you're preparing yourself for the future. What is R&D spends likely to be at for FY24? And also on the top line from the 650 crores odd, what kind of growth can you deliver?
Yeah, Nigel, very good morning. You always the one with the tricky questions. But jokes apart, in terms of R&D spend, that's an easier question to answer. We have posted, I think, about 7.5% as a percentage of the revenues of the R&D spend in the last fiscal year. And we expect as the overall top line goes up, we expect the percentage of the R&D spend to remain constant. And so as an absolute quantum, we will be spending more on R&D, and we have those plans already laid out for the upcoming fiscal year very well, and in terms of CapEx as well, in terms of the manpower and the R&D. In fact, we are already into plans after having doubled the R&D, tripled the R&D as of last 2 years. We are going to absolutely double that over the next 1 year. And so very strong plans for R&D in terms of growth. And we see the pipeline also correspondingly growing to justify that corresponding growth in the R&D. In terms of the growth in the year to come, in terms of top line growth, we expect to have good top line growth. We have the Site 3 and what we call the 3+ and 3++, and so basically added additional plots of land besides Site 3 already functional. We have the Site 4 that we are planning simultaneously with Site 5, and so significant production.
Give us a number, Aman. Aman, give us a number. Site 3 is on board, Site 4 comes on board. What is it? You did double digits, early double digits last year. Should we work with double digits this year as well? Do you want to increase it to mid-teens? And if you could tell us, since we're focusing on revenues, with your current CapEx plan, what is the peak revenue potential? So a growth for FY24 and peak revenue potential. Go ahead, Aman.
Yeah, Nigel. We've always maintained, I think, double-digit growth in the last many years, and we will certainly look at maintaining that ratio in this current fiscal year as well. I will refrain from giving actual numbers. In terms of peak potentials, we have always maintained an asset turn of 1.5 to 2, and we are putting in a capex of about, we already put in a capex of about 300 crores, 200 crores in the last fiscal year, and we have plans of 300 to 400 crores of capex in the current fiscal year and the years to come. And so multiplying that with the historical asset turn of 1.5 to 2 kind of gives you the peak potential of the new capex that has been going in. And so very upbeat on expansions in terms of R&D, pilot plant and production on the backing of significant inquiries and interest that we see from our customers, existing customers and new customers, which also is validated by the fact that we have just announced 3 significant announcements in the last few months.
All right, Aman, we'll leave it there. Thank you very much. Good speaking with you and appreciate you joining in on the program with some of the detail. We'll take a break here. We are back. Mitesh and Sudarshan will be with us with some technical trading ideas. Stay tuned. Okay, welcome back. Let's have the SGX Nifty up on your screens. Take a look at what that is indicating. It's a small start higher, 40 points after what was a disaster on Friday. 1% cut on the Nifty, 2.25% cut on the Bank Nifty, and broader markets did better, but they were also down about 0.75% each. But will we pick up on a new note after the session that we had on Friday on Wall Street? That's the question. Anuj is here in the studios to run us through what he's making of the picture. Anuj, morning.
Morning, Prashant, Sonia, Nigel. Well, yes, the day after the big shock, right, on Friday, the market was due for one round of selling. We discussed it on Friday. I, of course, didn't know that it will happen that soon and that quick and with that much quantity. But what Friday would have done is it would have taken a lot of weak hands out of trade, especially on the Bank Nifty. It was technical in nature, of course, due to HDFC Twins. Ex of HDFC Twins, the market wasn't too bad. In fact, HDFC Twins accounted for 172 out of 186 points of Nifty fall. But there was quite a bit of delivery selling, about 1,600 crores in HDFC and 3,000 crores in HDFC Bank, and tells you the kind of impact that they had. What it does is also provides a benchmark for us. Thursday's high now becomes near-term ceiling. And for today, you need to see how Nifty and Bank Nifty both move. And it's possible that, this is a bit of a corrective phase in which you get to the 20-day exponential moving average on both Nifty and Bank Nifty. On the Nifty, the day after the big red bar, it's normally a bit volatile. Every rally is vulnerable to be sold into. But there are two important supports. First is 18,000, the round number, and second is 17,885, which was last week's reasonable low for the market. On the Bank Nifty, it closed below the 10-day exponential moving average after long, 42,900. And the next important support is the 20-day exponential moving average, which comes in at 42,333. But as I said, more than levels, today I'll watch out for whether there's stability in the market and more importantly, in the HDFC Twins.
Okay, thanks a lot, Anuj, for that. Have a good one. We have Mitesh Thakkar and Sudarshan Sukhani joining in. So let's pose these questions to them. Sudarshan, good morning. How are you feeling about the market now? There is some ammunition that the bulls have this morning, but is it enough for the Nifty to get above that congestion zone of 18,200?
Good morning, Sonia. Well, your questions are so good, I don't even have to answer them easily. Half of that is answered by you itself. I'm feeling much better about the markets. Last week, I had said on Tuesday morning when we had a gap up that just get out and step aside. And that was a sensible idea because the markets chopped around, went up, went down, did nothing. Now, Sonia, after 4 days of chopping around, the markets have given us levels. That's very important. They have told us that there is some support at a certain level and some resistance. The numbers are not important because we are in an uptrend. And once we see a consolidation with clear support levels, then we want to buy that consolidation. I would be a buyer today, keep a stop a little wide with 17,950 and expect some more choppiness. It's not just that because I'm buying, the markets will oblige me. But I think this is a time to buy
now. Morning, gentlemen. Mitesh, what's your sense? I mean, as we were discussing on Friday, HDFC Twins were probably almost all of the fall that we saw, at least on the index, on the Nifty and the Bank Nifty as well. How do you price that into charts? I mean, prices are prices, so you got to go with what you have, right? Or will you make an exception for because of the kind of fall that you saw and how concentrated it was in two names? Go on.
Good morning, Prashant. I think, yes, the initial selling on the Nifty which started was because of HDFC Twins, and I think that pulled the index down big time. It was concentrated, no doubt about it, but I think that is kind of, this fall has damaged the hourly and the 2-hourly intraday chart. So while we are on, an area when the support comes in, closer to about 18,050 odd zones. My feeling is that after a bounce back, if we don't, start gaining strength, which means that if we don't start getting past 18,150 odd levels, there's a good chance that we'll come back and retest this 18,050 zone, maybe even break below it. So in the near term, to my understanding, the market will be choppy and mildly corrective, though I think in the broader term, I'm still very, very positive and therefore would want to buy into the markets eventually, but not now. I think, today if we get close to 18,150 and then don't show strength, we'll come back again into some kind of a selling mode. Around 17,950 is the best buying zone for me, so I'll wait for that area to come in.
All right. Morning, gentlemen. So it appears we're in a bit of a band, at least in the near term. But Mitesh, give us a couple of trading strategies that you have for us.
Yeah. Good morning, Nigel. I have 2 buys and 2 sells. So it's kind of, the market view which I have. Havels is a buy with a stop at 1270 for targets of 1320. And Maruti remains on the buy list with a stop at 8860 for targets of around 9150. On the selling side is M&M. Keep a stop at 1227. Look for targets of around 1185. And National Aluminum is a sell with a stop at 82 for targets of 76.
Okay. And Sudarshan, how about you? What would your stock ideas be?
Well, the trades are mixed because markets could be choppy with a bullish bias. So I say Prudential is a buy. The stock had a decent rally and the corrections are very mild and tepid. That tells us that there is more steam on the upside. Buy with a stop under 425. PVR has earlier come in my intraday short list. It continues to come again. It's making new lows. That's always worrisome. It's an intraday short with a stop above 1465. Amar Raja Batteries had a very good day on Friday when the rest of the market was falling. And it's just breaking out of a trading range. That's a buy with a stop under 590. And finally, RBL Bank is an intraday short with a stop above 156.
Okay, gentlemen, we'll have you back on soon. Thank you very much, both of you, for running us through your take on the index and some trading calls. Chandan Taparia is also with us, derivative and technical analyst at Motilal Oswal Financial Services. Chandan, good morning. Good to have you here. Start of a fresh week. How are things looking to you, to your mind? I mean, is this a market where on the dips you want to go long? Or you want to wait, let the price action tell you what it wants to do after what you saw on Friday?
Good morning, Prasant. Thanks for having me. So in the last week, we were moving in a range between 18,050 to 18,250. On Thursday, we have seen strong momentum led by selective banking and financial. But on Friday, the momentum got fizzled out. We have seen some data changes. The put-call ratio of both the indices has fell down sharply as we have seen sustained call writing in all immediate strikes. So which is making some hurdle in the market to higher zone. But major trend is positive, so because of their dips could be bought. However, we are finding some concern in the Bank Nifty index because it formed a strong bearish candle, which indicates some dip could be there. But Nifty is still comparatively in a stronger zone with the view that dips could be bought. However, looking at the data setup and change in the market internal and the PCR and the IV, we believe some dip be there, but overall we will continue to be buy on decline instance in the market. So as of now, the index which was moving in between 18,050 to 18,250 range may slightly shift lower. So I believe that 17,887 could be retested as a major support. And with that support, one can keep the stop loss of 17,777 to again play the bounce towards 18,250 kind of level. So the trading range may slightly shift lower, but we will continue to be with buy on decline stance with keeping the view on selective stock specific action in the market. But Bank Nifty 42,500 is going to be a decisive level. If today it manages to hold 42,500, then we can attempt for buy on dips. Otherwise, we'll go for backseat for witnessing some sort of decline in the bank index as well. Now, talking about stock specific in this market, we believe that given the condition of the resistance and support in broader indices and the data setup, better to be in the stock specific firm for next couple of days till market get stability over here. So recommending to buy positive stance in the auto, capital goods, defense, tires, and I think these are the sector and stock which could do well. So first that is buy on Maruti. We have seen a consolidation breakout. The stock has surpassed its falling supply trend line. Even a small pollen flake pattern breakout is visible on the hourly chart. We have seen put writing and built up of long positions. So recommending some positive stance in the counter. One can buy with a stop loss of 87.50 and the stock has potential to move towards 9300 level. Second trading idea, that is from capital goods. We have positive on the L&T, ABB, Siemens. Most of the capital goods stocks are doing well. Momentum and the strength is clearly visible. So recommending to buy on Siemens as making higher highs, higher lows. Built up are there. Rollover we have seen in the positive side. So recommending to buy with a stop loss of 35.60 and expecting Siemens to head towards 3800 kind of levels.
All right. Thanks a lot for that. So that's a couple of ideas that you can look at. Let's do one thing. Let's step into a quick break. When we come back, we'll have the pre-opening rate, so we'll be just in time for that. And we'll also have Gautam Saraugi of Go Fashions to discuss their Q4 earnings with us, so do stay tuned in.